I'm Douglas Farnham. I'm the policy director and the economist. As I was telling someone before, Sean Morris was the primary author and kind of mechanic putting this presentation together. In the back, we have Acting Commissioner Craig Bolio from the Tax Department. And then, my colleague from the Agency of Education, Bill Bates. The reason the Tax Department put this presentation together is that our opinion from the questions we get from taxpayers, the conversations with the legislature, is that this is a massively complex topic that not enough people understand. So we're trying to go around the state, we're trying to help people understand. We are also working on developing more educational materials to put online or to provide electronically, but it's a very complicated topic and it's difficult to explain. I liken it to trying to teach calculus online. You can't transmit all the minutia without a person there to respond to. So the cartoon on the front here, if you're not close enough to read it, we have some formulas leading to, and then in the middle, a miracle occurs. So I think for many of us, this gets at, and the professor's saying, I think you should be more specific here in step 2. So in the education property tax system, I think that there are several of those miracles that occur that people don't really understand what's going on. They have a good feel for the general kind of, if I vote up school spending, something bad will happen, but it's very hard to get specific and to actually know what that's going to be. So just as a warning, this is not intended for all audiences, although it is a little bit. It will have jokes about tax data and it will have complex calculations. So please bear with me if you're not a fan of tax nerd humor. So we're going to be going into the labyrinth of education property taxes today. There's a lot of complexity, twists and turns, and there's some monsters lurking in there that I'm going to help you understand. The CLA is the common level of appraisal. Income sensitization, I think that's been around for about 20 years now, so most people have a general idea of what that is intended to do at least. And then my favorite, which was introduced a couple of years ago, the property yield and the income yield, which are commonly referred to as the yield, but they're different things, even though they have similar roles. So that was created in about 2014, I think. So talking about those yields, every year the yield bill is passed by the legislature, and generally speaking around the end of the session, whenever that may end up being. If things are going okay, it's early to mid-May. If things are not as okay, late May, or sometimes even June 27th. So this bill traditionally has the property dollar equivalent yield, and that is, it sets a dollar amount where if you spend that amount per pupil, you get a $1 homestead tax rate in your district, which can translate to town, but not always. We'll get there. Income dollar equivalent yield, that's used for income sensitization. So that is the amount of money you can spend per pupil in that district and still get 2% of household income for the purposes of the property tax credit. So those are the two yields. One does the base tax rate, one does income sensitivity. They also affect different years. The property dollar yield is going to affect the upcoming tax year, the one you're entering right then. The income dollar equivalent yield is going to affect the claims that you file the next spring because they look back. So they kind of affect the same property tax year, but they hit at different times. And then the non-homestead base rate is set. Now that used to be called non-residential, which as someone who's done property assessment work, saying something is non-residential when people live in it and it's residential property was always confusing. So I'm one of the people that supported changing the word from non-residential to non-homestead. So you'll see in places in this presentation where non-residential is still used, and that's because some of our templates still had non-residential because the law was recently changed. So any questions about that yield bill before I move on? I think the reason I want to put that up front is that it's important to know that every year for taxes, these things are set by the legislature. and generally speaking at the end of the session in May or June. All right. So the way I want to approach this is to try to dissect a property tax bill. Now, this is basically the template that we worked out with NIMRIC after a law change recently, but towns, cities can use, they have control over there are some required elements, but towns and cities can have different layouts if they want. I don't know at this point how many towns and cities are using the NIMRIC template. I think it is most of them at this point since it was recently changed. Yeah, it used to be a lot more custom templates, and I think the law change actually pushed everyone onto the template, at least for now. So we're going to start with that top portion of the bill. What we have here is we've got summary and payment. So your bottom line is in your bottom right. You've got your assessed values up top, and this will reflect any exemptions like current use, or if you have a statutory exemption for being a church or a private school or something like that. You'll see those exemptions up there, or the veterans exemption is generally $40,000, I think, in every town now. The municipal property taxes are going to be on that left-hand side, and you'll see that there's a lot of space there. I think municipalities legitimately need more space because there are different rates, different highway district, fire district. There's a lot of complexity that can go into those municipal tax rates that you'll have more potential tax rates than you have with the education side. And then education property taxes are going to be on the right, generally right above that summary and payments amount. So within that, you've got your homestead and non-homestead. So homestead is the principal dwelling of a Vermonter. We have about a little over 170,000 principal residences of Vermonters owner-occupied statewide. And then non-homestead is everything else. It's a catch-all. It can be a renter. So it could be a single-family residence, a standalone house, but it's just not occupied by the owner. It could be a commercial apartment building, but it could be the mall, or any type of business property, commercial or otherwise. So your homestead is that value up there will feed down into the rate calculation and the tax calculation right there. And then you see I still have non-residential education there. This means the same thing as non-homestead for property taxes now. So going into non-homestead first, because that makes my head hurt less. This is where we are most similar to other states, just in the manner it's approached. So you have your non-homestead base rate that was set in that piece of legislation in May or June, divided by the common level of appraisal. That applies in every city or town in the state. Everyone gets their own CLA. I think that's important to recognize because it can be a unique number and it will move every year. It's a very precise calculation. And I think towns and cities can have a good idea of what's going to happen, but they don't generally know exactly what that number is going to be until December. And then you multiply that by that taxable homestead property value. That's your listed value, your assessed value. How much your property would be worth if it was sold on the fair market. And then that gets you your non-homestead education property tax. As I said, that's not that different from many other places. The main difference is that no one else applies the CLA into the tax rate. Equalizing, studying where listed values are in relation to fair market is common practice, best practice around the world. But it's generally used for informational purposes in other places. It's more of a report card. It's saying, you're slipping away from the market a little bit far. You might want to consider reappraising. So it's used more for guidance in other places. To be fair, there's also no statewide homestead or non-homestead rate in other states. So we have a somewhat unique system, and that's our way of adjusting from town to town. So the CLA, and as I said, it's a study of fair market value. It's the last 3 years of sales, and they have to be arm's length fair market transactions. So we work with the cities and the towns. We try to find out what's arm's length. We try to throw out sales that aren't arm's length. And then we have a thing called influential sales. If a particular sale, a massive sale, is moving the CLA of a town too much, we have a criteria for eliminating those. Because while you want everything to be considered that's valid in fair market, you don't want one particular sale to drive the results too much. And that's like, what, John, a 6-month process? I just wanted to highlight it because this is definitely a rabbit hole. I could do an entire presentation, a whole day, on the common level of appraisal, the equalization study, how we work with the towns and assessment professionals like John to really make sure that that measure is fair as possible. And in small towns in particular, it has a tendency to fluctuate. Burlington has a larger, more robust market, but a smaller town, you might only have 3 or 4 sales. And bouncing people's tax rate around based on a small number of sales, while it's legally legitimate, doesn't always feel like the right outcome from a fairness perspective. So going back to that tax bill, now I'm going to go into the homestead tax. You can see how excited I am about that. So we have this tax rate times the grand list value equals your taxes. That seems simple off the face of it. Everything that goes into that is not so simple. So I'm going to walk through. We start at the district level, school district level. You have excess spending penalties. That is only going to apply to a small number of towns in the state. It has to do with if you're above a certain threshold of average of the prior year spending. Now, I would defer to my colleague at AOE to really get into the nitty-gritty of all the pieces and parts that go into district education spending. That's not really my specialty. But that's the bottom line there is that, everything that's has to go into that school budget for that district goes into that number there. And then there's a potential, if it's over a threshold, to be double counted. And then that's over the equalized pupil count. Equalized pupil count, again, comes from the Agency of Education. It's published every year. It's based on information submitted by the school districts. I mostly just want to say it's not a one-for-one. It's a very specific and kind of rigorous process. And I understand that UVM is kind of studying that and may make recommendations on how to update the weighting formula, because English is a second language and elementary school students, high school students, they're all weighted differently because realistically they cost different amounts to educate. So it can't just be a head count because that would be unfair because pupils have different costs of education. So this first step is a lot of work between the school districts and the Agency of Education. So it's pre-tax department really getting involved. Per pupil spending is the product of months and months of work every year. So you get that per pupil spending number. And that's very important because that actually drives a lot of how the formulas, how the outcomes work for the towns that are voting on school budgets. So you take that per pupil spending and then you put it over that property dollar equivalent yield that was passed in May or June. So that's important to remember. We have per pupil spending that's determined by education spending voted at the town budgets, the school budgets voted at the towns in town meeting day, and then that's over that yield, which is generally published in May or June. That gets you your district level homestead rate. So then you have your district levels. And I always get this wrong, but I'm going to try anyway. I think it's a little bit over 150 school districts that are still the zone we're in statewide after Act 46. You take that, merger incentives, if any. Now, these are phasing out. So going into future fiscal years, we don't really have to worry about merger incentives for the moment. But these are an element that gets reintroduced every once in a while. Before Act 46, we had other merger incentives that were put in place. So I think this is a part of the formula that's going to crop up from time to time. If the legislature wants to incentivize certain behavior, they'll create things that can affect the district level homestead rates. Now you multiply that by the proportion of the town students expected to attend each school district. What I mean here is if you're in a certain town and you have 25% of your kids to this elementary school district and 50% to that high school district and 25% to a different one, you're going to have a composite rate. Generally speaking, we don't have towns with more than 3 different school districts right now. That's been consolidated from what it was in previous years. But it's important to know its proportionality. So you start by determining the district, and then each town's tax rate, your town tax rate will be weighted by how many students you're sending to that district. So if you have a low spending elementary school district and a high spending high school district, as your student population ages, you may see your tax rate go up just because you're sending students to a higher spending area. District education spending is a term that's defined by the Agency of Education, and some things are included and some things aren't. Like the per pupil spending that's determined here is not the same as the total per pupil spending if you determined it through the federal criteria. So yes, it's true. Not everything goes into that district education spending number, but that's the way it's defined and calculated. Once you've determined your town tax rate for that district, again, I said it's weighted by which districts you're sending your students to. You add all those up, and then you put it over that common level appraisal, that study of fair market value, and that gets you your actual homestead education tax rate. If you subtract the common level of appraisal from this, it's actually not, well, you subtract the common level of appraisal and possibly the yield from this, it's not that different from how property tax rates are determined in other states. A lot of this complexity in these parts, you do see some of those parallels in other states for determining school budgets. It's not the simplest process in the world. The introduction of the yield and the common level of appraisal are really the most unique elements of Vermont's structure. So that gets you your actual homestead education tax rate. All right, so all of that gets you your tax rate, which will be the same for every town, and then multiplied by the value of your particular property, your home, gets you your taxes, at least your top line amount. So, income sensitization. I think this is, again, a unique element of Vermont where we go a lot farther in trying to fine-tune it than you see in other states. So we have two general categories. And these numbers change every year. But resident households with income less than $136,500 for fiscal year 19. I think it was $138,000 and a little bit of change for fiscal year 20. It'll probably be a little bit higher for fiscal year 21 if there are no big law changes. They're eligible for income sensitization, a property tax credit, which shows up on your tax bill as a state payment. Above that amount, residents are not eligible for this program. So that's about 32% of Vermont households, so about 50,000 Vermont homeowners are not eligible for income sensitivity and just get the tax rate as we've walked through it. That homestead rate applied to the property value, and that's going to be the bill. I've heard of towns that told people, oh, if you're income sensitized, you can just vote for the school budget, it won't impact you. So those people likely voted under the premise that they weren't being impacted. They were. Their tax bills did go up because of their vote. So I will definitely show you how that happens going into this. So again, above 136 or 138,000, no education state payment. Under that threshold, there will be something in this line. We issue credits down to, I'm pretty sure I've seen $1 property tax credits. If the person bothered to fill out the form, we would issue the $1 credit to the town. Now, it's part of a big file, so it doesn't actually increase our operating costs that much to send it. So, because it's a file transfer to the towns right now. So, just breaking out those two larger categories. Again, greater than, we're done. We've basically calculated how you're going to receive your tax bill. Less than that amount. The complexity here is what I believe feeds into a lot of the perceptions that there's no impact. The slide that we walked through to calculate the district level homestead rates, if you take that and you replace the property dollar yield with the income dollar yield, then you multiply the result by 2%. You get the household income percentage for that town. So every town in Vermont has a unique household income percentage that is hooked to their per pupil spending. Through this formula, if you increase per pupil spending as it's defined with the types of spending that are counted, then you will get a number. The average, it was 2.47%, I believe, in fiscal year 19. So on average, Vermont towns, the property owners are paying, 2.5% or so of their income in property taxes before a credit's calculated. So that's why there's skin in the game. As you vote up higher spending, the amount of income, the amount of taxes you have to pay before a credit will be calculated for you also goes up. So effectively...
Does the credit also go up commensurately?
No. So if your town votes higher school spending, your property tax credits will be lower. In general, there are some very, very narrow circumstances where truly low-income people might be insulated, but that is a tiny fraction of the Vermont population. Out of our 620,000, I'm talking less than 10,000 would have the capability of being fully insulated. Now, so it's important to say that 2%, 2.5% average, a high-spending town, I've seen towns with over 3% because their per pupil spending is very high. And then not many towns below 2%, but I have seen towns go down to about 2% in a lower spending district. So that's the mechanism that helps sink. It's like the metaphor I've used before is that it's the water level. So as your per pupil spending, your water level rises, your threshold before the credit goes up as well. So you're effectively reducing the credits when you vote for higher school spending. So if you remember from the maze, the Minotaur, and again, a little narrow humor there, that's household income. I wish actually that I'd put a version of the household income form on this for you to see. We have 25 separate components of income. Our definition of household income in Vermont is more complicated than anything I've seen used anywhere in the nation. For context, Medicaid, federal program, uses modified adjusted gross income, which is federal adjusted gross income plus 4 things. 4. So you can go to your federal form, you take that AGI, you find those other 4 things, which very few people have 3 of the 4 things. So it's generally AGI plus 1 thing is the most common. Instead, we have fiddled with the definition of AGI over the last 20 years and created this massively complex 2-page form where you have to add up all of these different income types, basically almost recreating a federal tax return. It's more complex than our personal income tax return. So I think in complexity, getting at this household income figure is a big hurdle. And it also requires every person within those walls, whether or not they're part of your tax filing unit, has to contribute their numbers to that household income schedule. So if you have an unrelated party, I was actually talking to someone who hosted someone who was homeless, which is, I think, an excellent charitable act. They had to talk to that homeless person that they were hosting, get a detail of the income that person had, some of them from, public subsidies, include that on their household income schedule, and their property tax credit was reduced because they had given a homeless person some place to stay. So it's complicated and highly inclusive. Anyone within those 4 walls that you don't have a lease agreement with, the department is going to expect you to put the income on that. So, first I'm going to talk about above 47,000. 47,000 to 90,000 of income, you're going to sensitize, and this gets into that house site question you asked earlier, that 2 acres. Up to 2 acres and your primary dwelling can be included in that house site. That's your house site value, And if you're between 47 and 90,000, up to $400,000 of house site value can be included. For context, that's up to the top 3% of homes. Only 3% of homes statewide have a value over 400,000. In fairness, I'm in Chittenden County, so I can't just breeze over it. You know, local markets do have different percentages, so I wouldn't wager that the ratio is 3% in Chittenden. So a $400,000 house is not as extraordinary in Chittenden as it is in the rest of the state. But statewide, that covers 97% of your homes. If you're 90 to 136 or 138, so the 47 and the 90 are fixed in law. Those are real numbers that don't change every year unless the law changes. The 136 is the result of a calculation by the department. If you're 90 to 136 or so, you will include up to 225,000. And that's closer to median statewide value. So that covers, I believe, 80% of Vermont homes. But that house site value is more average. That was actually reduced from 250 to 225 a couple of years ago. This was reduced from 500 to 400, which 500,000 actually covered up to the top 1% of homes. Now, then you subtract the amount household would have paid based on income. So that is, as I talked about, how every town has that income percentage that's calculated based on the spending. So generally between 2 and 3%. You multiply your household income by that percentage and you get the amount that you would have paid based on income. That's where the control is for increasing spending reduces your credit. And then it's capped at $5,600 as the education state payment. In your homestead tax rate, the CLA, the common level of appraisal, that sales study, adjusts for things like reappraisal. Honestly, the amount of education taxes you pay as a town or as a city should be roughly the same before and after a reappraisal. Now, certain high-value properties could cause some things to fluctuate because a big enough property will move the needle. But in general, residential properties, Burlington's 79, 78 on the CLA right now?
We're at 77, but in
77.
reality we're 72, 73%.
Right. So,
That's the CLA percent?
Yes.
yeah. So that's adjusting Burlington's tax rate up right now. After the reappraisal, the CLA will go up to 1, meaning the tax rate will go down, but the values on the grand list will have gone up. In the income sensitization program, this 400 and 225, these are hard-coded, they're written in law. They're not adjusted or accounted for. So a reappraisal like the one seeing in Burlington, it will have the potential to reduce people's income sensitivity and reduce property tax credits. It's math. I can't pretend that it wouldn't. Because we use these fixed statewide house site values. It's just a consequence of the formula. So I know that the legislature looks at these numbers over time, but that is an element of the current system, absolutely. So, 0 to 47K, similar but completely different. So you have that 400,000 on your house site value. I'm going to start with the education tax row. So 0 to 90,000 of income has the same house site value that's eligible. Sorry for jumping around. I just want to throw one thing out. When you hit 90,001 of household income, if you have a $400,000 house, you'll lose about $2,700. So it's a cliff in our current system. There's a cliff at 47,000 and there's a bigger cliff at 90,000. So it causes people to make certain decisions. If you can control your income, you might control it in a way that you would stay underneath these numbers, which are not indexed and have the 47,000 has been in place for at least 15 or 20 years, I believe. And the 90,000 was created, I think, around 10 years ago, maybe a little bit longer, but those numbers don't move with anything. They don't move with the median income in Vermont or anything like that. They're just,
But are they also based on the net income or gross income?
the gross, the household income, the 25 elements of anyone living in those walls include absolutely anything you can. My least favorite instance is when someone has their elder parent move in with them to care for them, and then that elder parent's Social Security income results in a reduced property tax credit. Even though the amount that they're spending caring for their elder parent, they're not making any money. They're not in a better position to pay their taxes because of their elderly parent moving in with them. And adult children have the same effect. If an adult child hasn't quite figured out a way to afford their own place, they're going to reduce the parent's property tax credit. So, for 0 to 47,000, there's an education credit and a municipal credit. The education credit has fixed brackets. These brackets are not linked to local school spending. So it's 5%, 1.5%, 2%. They result in a credit of up to 56,000. But again, this audience that is under 47,000 is much more limited. And if they're receiving the maximum credit of 5,600 already, because it's capped, then any increases in the property taxes will overflow. Basically, the credit's capped. So if they vote to increase school spending, that results in more taxes than 5,600, or more taxes than 6,540 then you're going to see impact on their tax bill.
On whose tax bill?
On a low-income household, 47,000 and under. Again, that cap of 5,600 creates a situation where if they vote for higher school spending, but their credit's already capped out, then they will have to cover those taxes themselves. So an $8,000 cap was put in place some time ago. And then when I say last year, I mean the 2018 legislative session. The $8,000 cap was split into two elements: 5,600 for education, state,
Right,
and 2,400 for municipal. So it was separated. That was done in a generally revenue neutral way, meaning it didn't, on a statewide level, increase or decrease the amount of money we were putting out for these credits, but it did change some people's experience. Generally speaking, if you have a higher municipal tax rate, then it's much easier for a low-income household to come up against 2,400 of municipal taxes, So I think that's the top row is the state. The bottom, that prior year municipal tax on house site value, I think it's important to note here, that is not the $400,000 cap. That is prior year municipal tax on anything included in the house site. One reason we don't do that is because there's no such thing as an equalized house site value for municipal tax purposes. It's apples and oranges. We don't equalize at the municipal level because it's all within the town. And then there's two rates, 1.5% and 3%, which results in a max at 47,000 or 46,999. You would be expected to pay 1,410 of municipal taxes on your own before a credit's calced. So to get max credit, the numbers work out to be about 3,800 in municipal taxes at a 46,999 income household would get that max credit. So that is often referred to as super circuit breaker, and the main reason being that municipal tax relief program pre-existed the Act 60, Act 68 income sensitivity. So this little row is kind of an older serving program that I think has been around for 30 years or longer, where there was some municipal tax relief. So that is all going into the calculation of this number here, this education state payment. And that is one reason I personally think it is difficult to impossible for most people to understand all of those moving parts and pieces and parts to know what their education state payment is going to be. Now, we do, after the yield is published, we put up a income sensitivity, we put up a credit calculator to help people try to figure out what their credit's going to be. But that is based on the prior year's income yield, and it doesn't reflect the decisions that are going to be made in the spring when voting on school budgets. Because again, that property tax credit is based off last year's income and last year's property taxes. So, we have in yellow the education state payment, in blue the municipal state payment. And again, those are separately capped and add up to $8,000 together. They can show up in the total state payment line here. Just because we don't like it when things are overly simple, if you claim a property tax, if you take your income tax refund and you apply it to your property taxes, you get a little bit of preferential treatment, and that goes into that education state payment line. So if someone has a refund from income taxes that they want to use to pay their property taxes, it'll show up there with a 1% discount on the amount of refund that they use to pay their property taxes. So not a 1% discount on the total bill, but only on what you choose to use to pay. And then it'll be rolled into that line, the education state payment line. Another fun bit of trivia here, municipal state payment line. If you live in a mobile home park, trailer park, where basically if you have any property that's unlanded, it's usually mobile homes that fall into this category. The lot rent that the mobile homeowner pays to the owner of the land underneath, that actually is included in this credit calculation. There's a way that that works into the credit calculation, and that will show up in the municipal state payment line. So even though it's really an education state payment, the way the law was drafted, if there's an unlanded mobile home, it will show up differently on the tax bill and be subject to the 2,400 cap now. Normally, mobile homes don't have any problem about running up against the payment caps. Generally, they're not high enough value. So, actually, before I move off of the bill, I'm going to move into talking about the timing of how all of this fits together and all of the kind of the back and forth. So, timeline. This is definitely, doing this presentation, really constructing this timeline has helped me see how interesting this process is from an organizational standpoint. So I've got state government. That's going to include state of Vermont, executive branch like myself, legislative branch, and then taxpayer calendar. You can see the dotted line there is the fiscal year. So that is the state fiscal year, which is not necessarily the town fiscal year. I think rough cut, maybe 3/4 of towns are on the same fiscal year. It might be more than that. I haven't actually looked at it recently. I know that there are still towns that are on a calendar year or on a September to October. I know that they still exist, but I think that they're the minority now. So generally speaking, we're worried about this fiscal year, which lines up with the education fiscal year. So where the rubber hits the road, all that complexity goes into you receive your property tax bill, and then about 74 cities and towns, municipalities in Vermont bill in July. The law says 30 days are required before the payment can be due. So about 1/4 of the state sees those first property tax bills due in August. So that's when the rubber really, hits the road. That can vary between 4 payments, quarterly payments, 2, 3, 1. I mean, it's completely up to the town. It's a voted thing at the town level. So it depends on where you live. That first bill is going to be reduced by the credit. Now, again, we take a lot of information from 2019, generally submitted by the taxpayer. We bring it up forward. We have to wait on some things in the legislative process, and we have to process it in the department. And then we bring it back down. It's going to go through the towns, which you can't see yet, and it's going to hit that first payment if everything works properly. So, income tax is submitted. Property tax credit claim is due April 15th. That's going up to the Vermont Tax Department. Then the legislature, between May and June, will pass the yield bill. That's important because the yield bill is necessary for the tax rates, the base rate that's going to be used here. The property tax credit claim was based on the yield bill passed the prior year. So we're not waiting to calculate the credit. We generally have processed a lot of those and spend a lot of time on those the first 6 months of the year. After the yield bill is passed, we turn around the tax rates as quickly as possible. So then we take the rates, we use the credit income yield from the last year, and we send it to the towns. Law says we have to send those property tax credit information. We have to send that on July 1st. So we try to have the homestead rates ready by July 1st as well, as long as all the school budgets have been finalized for that city or town. So if everything works well, we send a file out on July 1st that covers all of the timely claims and some of the people that filed just after the due date for the property tax credit. This is one thing I'll share that complicates the system and frustrates the towns. April 15th is the due date, but you can file late up until October 15th. And that's going to require a rebilling, generally speaking. So it causes a lot of additional billings, a lot of additional administrative work for the towns and the state. Town government fiscal year. The prior year, I talked a little bit about publishing the CLA from the equalization study. So that CLA that was published in December is used with the yield. Those are the two main parts necessary and the per pupil rates to calculate these homestead rates right here. So we do have the common level of appraisal in December, and then Commissioner Bolio on December 1st published a letter predicting what the yields would be if education spending, total education spending, followed basically what we're seeing in submitted school budgets to this point. I think it was 6, possibly 7 cents increase this year. So then we have town meeting day. So town meeting day, that's when actually all of these school budgets are, at least for the first time, and in recent years we've seen a high approval rate for school budgets, but that's when these are voted on by the town. So just to show you, the CLA, the predictive yield that the commissioner produces and the CLA, that goes into the school budget, the school district's determinations and how they build the budgets they present to the town. And that has to have estimated information on it. So it has an estimated tax rate if you vote for this budget. But it can't be a real tax rate when they vote here, because the yield, which is needed to determine the homestead rates, that's not going to be passed for 3 more months. So when you vote at the town or city level, you're voting on an approximate tax rate. And I've been working in or near the legislative process for setting the tax rates for the last 4 or 5 years in my current role and my prior role as the property director. And that number changes a lot as between January and June, it shifts around quite a bit. So the odds that the yield that the commissioner predicted a couple weeks ago is what we get coming out of the legislative session, I think are extremely low. But I highlight that to show the towns have to make a decision at that point without complete information. And then overlaying on that, you have the school calendar. So school budget preparation begins generally back in September in most districts, which is before that CLA was produced. And of course, well before the yield was set to know what the financial impacts of voting on that budget will be. So that my attempt to visualize how we have things from the prior year flowing forward, coming up through school districts, towns, the state, coming back down to the town, and then out to the taxpayer. And all of that goes into that first payment that people receive in August or September. At this point, with the exception of the legislature voting on a yield bill in June, I don't know that anyone in the process before the legislature is making an informed decision where they know the outcomes of their decision. And I think that's really important, because when you're making a decision, if someone tells you, well, you can do this and this might be what happens, it's pretty close to what happens, that takes a lot of the importance and the ownership, the control of that decision out of your hands. So yeah, I think one reason I wanted to highlight this timeline is that it bounces back and forth. People are forced to make decisions without complete information. It's not logical and doesn't build in a way that I think supports really accurate decision making. To be fair, people can have a general sense within a couple cents on the tax rate what impact their decision is likely to have. But again, I think psychologically that's really important. If I was filling out my income taxes and what I submitted may or may not be, it might get, we do adjust based on numbers being wrong, but if the real numbers on my income tax return might result in a couple percentage points one way or the other, and I might get a bill bigger than I expected, that would impact me. When we have to adjust returns based on information we receive at the department, that's definitely impactful to those taxpayers. So voting on one thing and then seeing another thing come out of it is not healthy, I don't think. The other thing I'd point out is that last year, the Vermont League of Cities and Towns, so not the department, looked at how many people participate in school budget votes and how many people were actually there and voted in person. 17%. 17% participation rate is not anywhere close to what I would call engaged and informed decisions. We have a low participation rate. I think our property taxes are repeatedly highlighted as one of, we do have high property taxes relative to other states. And we're not the highest in the country, but we're always in the top 10. People complain, but then they don't engage. And I think part of the reason I wouldn't engage and didn't before I worked at the department is that if I'm not completely understanding how the system works or not fully buying into it, then I might not choose to engage. As someone who's worked at the tax department, not representing, a proposal by the administration or anything like that. But from my opinion as a tax administrator, in this calendar, you basically have a series of decisions made with incomplete information so that the legislature can make a decision with complete information here. While we say our system has local control, that means the people that are making the local decisions are doing it without actual control, without complete information. So one thing that could be discussed is if you were setting the yield, if this yield bill, just like with the property tax credit, was setting the homestead rate for the upcoming year, then everyone in this string of events would have complete information with the exception of the school districts that start budgeting without the CLA. Now, maybe we could also talk about when we time the study and how that's published. Ideally, you'd have known factors of statewide impact, statewide calculation for the school districts when they start budgeting. You'd have the foundational factors. Now, the risk is you either under budget or over budget if you pass the yield the prior year. So I think the tendency would be to be fiscally conservative. And if you move the yield back to the prior year, you could end up with a system where the legislature was passing higher yields, and then we're ending up with bigger carry forwards until we figured out how to fine-tune the system, passing it a year ahead of time. Like for instance, right now, everything we're seeing at the state level indicates a 7-cent increase in property taxes on both rates. If we were to have a system like what I'm talking about, that would become the rate. based on information we have now, we'd be forced to set a rate, a 7-cent increase. And then people would have to make decisions based on that, that average 7-cent increase. So I think we could make it so that people had more complete information going down the line, but there would be some cons to that approach. There would be potentially higher tax rates in an effort to make sure that we didn't run out of money in the education fund. Because when you're having 150 districts making, different decisions, you need to account for that. You need to account for the risk and build in a little bit of extra money. The reason the legislature votes here is to fine tune it and get that yield as, well, actually it's not as low as possible, it's as high as possible to allow for lower tax rates. Because the higher the yield, the lower the tax rates. So I think from a timing perspective, that is something I think could be looked at as one piece that you could move that might make all of the other sequences, moving the CLA. That's a sales study. I don't know why that couldn't be, why the timeframes for that couldn't be adjusted so that we publish that at a different time of year. So we made it. Thank you, everybody. Thank you for your comments. I know that this is too much complexity to walk away from here and think, I got it. I remember every aspect of it. But I was intending this as a primer and to help spur conversation and a little bit better understanding.